So we'll start from this problem. So this problem is about forecasting the SOPL and SOFP. So we'll read the requirement so we'll get an idea. Prepare the following forecast financial statements for APX Co using the information provided. So we have to prepare a forecasted SOPL and we also have to prepare a forecasted SOFP. So these are our two statements that we have to prepare, and these have to be prepared based upon the ratios. So we'll read the question here. APX Co achieved a revenue of 16 million in the year that has just ended and expects revenue growth of 8.4 in the next year. Okay, so the current year revenue is 16 million. Next year it is going to grow by 8.4%. The financial statements of APX Co for the year that has just ended contain the following statements of financial position. So they have given current asset, inventory, trade receivable, then ordinary shares reserve, then long-term bank loan, current liability, trade payables and overdraft. So they have given all these data. And apart from that, we also have the long-term bank loan has a fixed annual interest rate of 8%. Okay, so the bank loan has an interest of 8%. APX Co pays taxation at an annual rate of 30%. So the taxation rate is 30%. The following accounting ratios have been forecast for the year, for the next year. So gross profit margin has been 30%, operating profit margin 20%, dividend payout is 50%, and inventory turnover period is 110 days, receivable period is 65 days, and the trade payables period is 75 days. Okay, so overdraft interest in the next year is to be forecasted at, so the interest alone for overdraft is going to be 1,40,000 or $140,000. No change is expected at the level of non-current assets, and depreciation should be ignored. Okay, so that's about the concept here. So what we'll do is we will first create SOPL, and then we will try to create the SOFP. Okay, so we have pushed that. So let's create the SOPL. So we'll start from revenue. So revenue is going to be, we'll work out all the numbers in terms of million itself, dollar million. So it's going to be 16 million into 1.084. So that would be the revenue here. So you got your revenue. So next is to get the other numbers. Okay, so the next one he has given us gross profit. So gross profit is 30%. So we'll put gross profit here. So 30% of the sale would be the gross profit. So what would be the difference? So the difference between these two numbers, 17.344 minus 5.2032, so that number will be the cost of sales. Right, so that's done. So what's about the next number? So the next number is about operating profit. So operating profit is, if you see, it is 20%. So this would be operating expense, right? So the difference between these two numbers, okay, so that's about the operating profit. We got it. So thereafter, from operating profit, we can have interest and tax and things like that. So let's see the interest. So interest, there are like two interests here. One is the bank loan interest and the other one is the overdraft interest. So there are two interests here. So both we will take into account. So bank loan interest and overdraft interest. We have two things here. So bank loan interest, if you take here, that is going to be 8% of bank loan is here, 10 million. So all numbers we are working out in only in terms of million only. So that's 0.8. Next we'll go to the OD interest. OD is going to be, I think they have already mentioned it, it is 140,000. So 140,000 should be converted into million. Okay, so this is going to be the interest, and we can put it as profit before tax. So you can take the operating profit, deduct these two numbers, and you get the answer. So thereafter, I think we can get the tax. So tax is going to be, he says it as a 30% tax, 30% of 2.5288. So we can get profit after tax now. So we got profit after tax. So after profit after tax, we have the dividend payout. So dividend, okay. So dividend, he says it's going to be 50%. So 50% of 1.77016. So dividend is 0.8508 dividend we got. So the balance would be transfer transfer to reserves. Okay, transfer to reserve or transfer to retained earnings. So it would be 1.7 minus this. It would be same number only. Okay, so just highlight certain numbers. Usually the gross profit, the operating profit, profit before tax, profit after tax, and transfer to reserve. These are like key numbers. So we will take it as, we'll just highlight that. So next we have to find out our SOFP. So we can start with that. So forecast and SOFP. So we can start from the capital and we can start from non-current assets. Or better, we'll start from asset side. So first we'll start from non-current asset. So non-current asset, there is no information, so it would be the same. It would be 22. Then we have inventory. Okay, because they have given in the, for non-current asset, they have given in the note that there is no depreciation, so you can have it as the same number. For inventory, they are saying that it is going to change to 110 days. Okay, inventory is going to be held for 110 days. Okay, so to work out this, we will have to have a working note, or else we can't get the answer. So working note, we will have it as inventory. Okay, so what we are doing here is we are trying to get a reverse kind of a relationship, right? We are trying to get a reverse relationship. So the relationship is going to be 365 divided by inventory turnover ratio. Okay, so we know what is going to be the, I think we can work it out like this. We know what is our inventory days. Inventory days is 110. So as they have not given how many days it is, okay, the days calculation is not given properly. So we will assume that it is 365 days itself. So if we solve this, we'll get the inventory turnover ratio. So we'll first get that. So what would happen is the inventory turnover ratio will go to other side, right, and will become a multiplication, and this 110 will go to the opposite side and will become a division. Okay, so now we can easily get the answer. So the answer is inventory turnover ratio is 3.38, right? So we can get it here. It is 3.31818, and cost of goods sold, we have already found it out. So cost of goods sold is here. It is, we just mark it 12.1408. right? We can get that number. So that is our cost of goods sold divided by average inventory. So now what we can do is the average inventory will go to the other side, and this number will become a dividing number. Okay, so this is our inventory. So our inventory is 3.65. So we can take that 3.65 or 3.66, we can round it off. So inventory comes to 3.66. Done. From where did we get? We get it from working note number 1. Okay. So the next item is going to be receivables. So receivables also we have to work out in the same way. So it is going to be working note number 2. So we can start from here. This is working note number 1. We have done that. Working note number 2. We can start. So what is the number that we have? So trade receivables we have 65 days. Okay, 65 days. So the ratio that we have to start with is this ratio. So number of days becomes 65. Okay, so the receivable turnover ratio is 5.6. So that we can insert here. So we know that it is 5.61538. So all that we want is a credit sale. So we'll make an assumption. All sales are credit sale. Assuming all sales are credit sales. If that is going to be the case, let's see what is our sales. It is 17.344. So we can get our answer now. So our answer comes to 3.0886. Okay, so that is going to be our average debtors. So we can round it off to 3.09. Our receivable is 3.09. So we got that. Let's see what other numbers are missing from the asset side. See, from the asset side, we don't have any other numbers. We can get the asset total. So the total asset is 28.75. and we can move on to the liability side. So we have ordinary shares. So there's no difference given in ordinary shares. So it's going to be the same number. It would be the 5. The next one is a reserve. So reserves, the number is already given. The number which is given is 7.5. Okay, plus the transfer to the reserve, this number. So the previous profits and the current year profits. So both put together will come here. Right. So next going to be the long-term loans. So the long-term loans, they have not given any different information, they have not given. Okay, so it's going to be the same 10. They have not told anything is going to be repaid or anything like that. So thereafter we are coming to our current liability. So our current liabilities are going to be trade payables and overdraft. Okay, so trade payables, we have to have a working note or else we can't work it out. And they have also given the trade payables as 75 days. So we'll get the working note number 2. So he has given us the payable days. So the payable days is 75. We can take that as a number. Okay, so the answer comes to 4.866. So that's about the answer. So let's get the other ratio. So we have to get a number for credit purchase. So we do not have anything for credit purchase. So we'll take the cost of sales number. It is 12.1408. 12.1408. So we can solve it. Okay, and before that we will make a assumption. Assume all cost of sales as credit purchase. Okay, so the answer comes to 2.4946. I think we can round it off to 2.5 itself. We can just have to, I think, 2.49. So we can put it here. 0.49 and it's working note number 3. So let's get the total liabilities. So total liabilities would be, okay, we'll just put it. Okay, comes to 25.87, but here total asset seems to be higher. So what is the difference? See, the overdraft is 2.2. Let's put that and check our answer. Even if you put 2.2, it is not tallying. Okay, so it seems the company has borrowed overdraft interest. Okay, overdraft, they have borrowed a little bit more. So this has to be the only balancing figure. See, we can't, because all the other numbers are pretty much the same. So we can say that the balancing figure is this number. Okay, so how do we balance it? Okay, I think we'll remove this one. So it would be 25.8751. Okay, so the difference between, see, this is the total asset, this is the total liability. The difference between these two, okay, these two should be the overdraft. So this number minus this number should be the overdraft. So we can say that 2.87492. okay, this to be the balancing figure. Okay, so what we'll do is we'll mark it in a different color so that it's like quite visible. So this is a 10 mark question here, and we have solved it in around some half an hour time. So for teaching purpose, it usually takes a little more higher time. It will take a higher time. So that's about our concept here. So hope you guys got a good idea, right? So I'll just summarize it. So once you get this kind of a forecasting question, okay, the forecasting questions do not follow a same pattern, they differ. So in this question, they have given you revenue, but they have said it is going to increase. They have given you GP percentage, they have given OP percentage. So your job was like very simply to compute cost of sales and operating expenses easily. Then it's about interest expense and bank loan. So sorry, bank loan and overdraft interest that we calculated quite easily. Then tax was there. Then we found out profit after tax. Then there was like dividend information. Then we finally transferred to reserve. Non-current asset information is not given here. Okay, so no information is being given like bought or sold or depreciation. So directly whatever the number was, we have put it here. For inventory and receivables, there were like working notes and they have given the days. So we had to follow that. Shares have not been issued or bought back. So it's the same number of shares. Reserves are the same. Okay, reserves are same, but you have to add the current year profit also to it. Long-term loans remain the same. Trade payables, we have found out it through a working note, and the balancing number is the overdraft. Okay, so that's about this problem.